Howdy, Apex. Thanks for coming. Yeah, I'm Red. I'm a research analyst at Messari. Data is kind of the name of the game for us. Think of it as like the Bloomberg of crypto. We try to add some transparency to a space where, yes, it's all on-chain, but it's sometimes hard to understand what's going on. And we've been talking a bit about RWAs. I'm going to put a hopefully unique twist on it so we can get into some other aspects of it. So I'll do a quick zoom out, look at DeFi, jump into RWAs, what they started as and what maybe the next evolution of them will be, and then what does that look like on the XRP Ledger and in its broader ecosystem? Because it is no longer one network, it is a group of side chains, and we're getting some modularity in there, which is fun. Zooming out on the state of DeFi, in short, it is probably on Ethereum. If it's not on Ethereum, it's on the EVM. And we see that with ETH having a majority of the TVL. We see that with Tron, Binance, Avalanche, all these other networks that are using the EVM, similar to the Evmos client that is used for PeerSyst's EVM sidechain. And we're seeing that is where users and liquidity are. We are seeing $100 billion+ of total value locked on all of these networks put together. And that brings us to RWAs, which are very intertwined with DeFi. And the most popular RWA, which is stablecoin, is kind of the core of DeFi, and it helps a lot of it run. I don't think we'd be anywhere near where we are in terms of applications, users, and liquidity without that specific RWA. I'm sure you all have a good idea of what they are now, but yeah, let's take some off-chain assets, let's put them on-chain, let's tokenize them, let's get all those good things that we have about crypto, and let's have our real-world off-chain assets inherit them. The 24/7 trading, the democratization of access to these assets, the ability to fragment them and break them up into pieces, adding a different flavor of democratization. One is just being able to access them, but two is if you can break these things up, you can lower the price point, more people can get involved. Generally, we have two types, tangible and intangible. So when some people hear RWA, you might think of like a house or maybe like a Rolex or something like that. You might also think your TradFi assets, so US Treasuries and things like that. They both have some benefits. They both share some similar challenges. So what some of those challenges look like is, other than like commodities, we still have regulation involved. So when you think of on-chain assets, we're talking about decentralized assets, right? No one has a say in whether you send someone else XRP. That's completely up to you and the recipient. This is a sovereign asset. But when you deal with something that is regulated off-chain, the situation changes a little bit. So I've got a house, I'm representing it, as an NFT, and if I want to transfer that to someone, well, yeah, I can send the NFT, but if my local government does not recognize that sale, then did I sell the house? Like, no, we still have this regulation, we still have parties that have a say in it. It makes it an asset that is not completely sovereign, and that's the case with our stablecoins today. If you look at USDC or USDT, you can have a blacklist of an address, and there are some kind of safety features built in there, and these are needed for regulatory reasons. And if you were the issuer, Circle or Tether, or with RLUSD, Ripple being the issuer, you want to have that control. You want to be compliant. So this changes a bit of what these tokenized assets look like compared to traditional crypto assets, which are completely sovereign and completely decentralized, and you have full autonomy over your assets and what you're doing with them. Now, diving a little bit deeper into stablecoins, looking at the state of stablecoins today, $161 billion market cap. I've got a couple charts here that show the meteoric rise of stablecoins outpacing some, popular TradFi payment rails, like a MasterCard, and then even Bitcoin, which, might be surprising as stablecoins are, almost secondary in the crypto world, right? Your native asset, your BTC or your XRP, is thought of as like, hey, this is the main course, and stables are off to the side, but they actually do more transfer volume. And that happens in a lot of places, not just ETH, this happens on Tron and other networks as well. But the bottom line is, and I hope the irony is not lost on you, that fiat money and the US dollar are super popular on crypto. I mean, crypto exists because, for a large reason, a lot of people were not satisfied with fiat. So we made crypto, and what do we use it for? To transfer fiat. We're kind of coming full circle here. Looking at USDC and USDT, these are the two largest and most popular stablecoins, and we're going to have a lot of diversity in stablecoins because we have different people that want different ones for different reasons. Looking at this chart here, we have some data from Coinmetrics where it just shows frequency of on-chain transactions, and that gives you a pretty good idea, assuming people are awake at normal hours, of who is actually transferring these assets. We can see that the West favors USDC. We can see that the East prefers USDT based on times of the transactions. These are not our only two stables. Probably the next largest one, or the one that was the largest after these, was UST, Terra Luna, and you probably have some bad memories of that one if you were involved because it exploded. And some people think that was because it was an algorithmic stablecoin rather than having a governed peg. I would argue the issue with UST was actually that it used endogenous collateral, and algorithmic stablecoins can actually work fine. So you can have different backings, whether your backing is fiat or BTC. You can have governed pegs. You can have a fixed price, $1. It can be floating, like RWA, where it's not actually fixed to one price, which, inflation is real, so the US dollar is not exactly a fixed price either. But there are a lot of permutations on what we can do, and we really have not cracked the door open on that yet. We're really just using the same kinds of assets. And what I have here is a case study on what happens to a DeFi ecosystem when stablecoins get introduced. And it's a very predictable pattern of what's going to happen in the ecosystem. I used Cardano as a case study because Cardano has a novel execution environment. It's not using the EVM. And Cardano had a couple stablecoins introduced, and its TVL exploded. And that is rather predictable in any environment, because what do people want to do with their money when they're getting into DeFi? Maybe they want some yield, maybe they want to lock it up in a liquidity pair, but you don't really want to be pairing two volatile assets, right? So the dollar is, it's the global reserve currency. It is the asset of choice to do your DeFi pairings. So once you have a stable coin and I can pair my XRP with something else that's stable, yes, this is interesting to people. Rather than them having to use a volatile asset and have to keep an eye on it, and people want escapes from volatility. So particularly relevant right now, as we just got an AMM live on the XRP Ledger, but this is pretty common throughout ecosystems, and both of the stablecoins here are not fiat-backed. Fiat-backed, as USDC, USDT, and they're governed, is generally the favored type based on just TVL and usage, on what we see people actually like to put their money in and feel safe about. And that's not even the case there. In this example, this case study of a one-year look at TVL and stablecoin growth. Now, looking past fiat-backed stablecoins into other types of RWAs, because stablecoins are not the end. You think everyone's going to stop at spot? They don't want yield or anything. They don't want to get into some more interesting assets. Stablecoins are the name of the game in finance on-chain, but that seems so simple when you look at traditional finance, right? Like if the dollar was the end goal, no. People want all these complicated investment vehicles, and they want to get fancy with it. They want to experiment with stuff. So, the dollar is really just the bedrock, the baseline infrastructure. We've seen growth not to the same degree that we've seen with stables. It's at $161 billion in stablecoin value. So we're seeing growth, but not to the same degree yet. This is just showing some, a little 4x in some alternative types. And these are things like commodities. These are things like US Treasuries, things like real estate. And they're all kind of just getting their footing. the difference with some of these assets, remember I was talking before about, hey, we still have regulation, we still have entities that they need to be pulled into the loop. You can't really do this without pulling in a local government that has a say in real estate. You need regulation and you need asset holders to be approved to be holding treasuries. So some of that foundation is being laid, and some of the early movers are getting into that. But what do we need for these new RWAs? What do we still need? KYC controls are one thing. KYC is know your customer. This is, identity, really. And it could be, having to show someone your driver's license every time you want to get onboarded to a platform. Not really favorable, kind of against the cypherpunk ethos that bring many of us here. But there are other ways to do this. DIDs, decentralized identities, are one way. So, we're on this one. We're exploring it. We need on-chain issuers to get involved. If we have an ETF and I want to be able to buy that ETF on-chain, eat some ETF from Fidelity or whatever, well, either Fidelity needs to say, hey, I'm on board, I'm going to go put it on-chain, or we need some intermediary to go and take Fidelity's ETF, custody it, and put it on-chain themselves. So a couple ways to do that, but we need to warm up to on-chain issuers, which I think we see happening. We saw the Bitcoin ETFs get approved, and well over $10 billion of net flows in less than 6 months, or maybe just 6 months now. So TradFi is interested. We have this legitimacy from the U.S. government and from the SEC, which goes a long way with reputable companies that want to be compliant. So we're seeing some more of that now. We also need compliance tools. I talked about, I just send you this NFT that's a house. It doesn't mean you own it yet, because the blockchain says you own it, but the government doesn't think you own it. So, completely out of touch there. We need compliance tools. We need companies to be able to safely issue these things. And I mentioned there's a little bit of that with USDC. In a fully programmable environment where things are Turing complete, you can kind of set up your token however you want. So the double-edged sword of issued assets, issued currencies on the XRP ledger, hey, really easy to put this out, but you don't have that full composability. Luckily, we have a lot of enshrined tools that are ready to go on XRP Ledger. So before, that would look like trust lines and kind of deciding, hey, who can hold this asset, which wallets are not on the OFAC sanction list. And we have more recent tools like clawbacks, which similar to that USDC part, this is just more of an enshrined feature of, hey, I need to take this money back because I don't want some malicious actor, using funds that I issued and tokenized on chain. And then institutional adoption, I will keep hammering that this one is not solved yet. Part of it is we need to make it easy for them. Institutions are not going to go do all this hard work and figure it out if they don't know if there's a future with it. But if it's very simple for them to do, if we have all the infrastructure in place, things like clawbacks, institutional adoption gets a little bit easier. Things like regulation, like the ETFs, it makes it a little more friendly to get involved there. I think US Treasuries are the RWA to keep an eye on. We do see shifts with interest rates. So, crypto is not decoupled from the larger financial ecosystem in that when interest rates change, we see a difference on where people are looking to put their money. If you can get higher yields from stablecoins that are backed by treasuries, yeah, you're going to go do that. But if those US Treasury yields are really low, then people are going to go back to their degen DeFi yield and go use it over there. Private credit had a moment in 2022 where it grew quite a bit, and it hasn't been as strong since then. People are still building in that area, but US Treasuries are a big one. MakerDAO is a Web3 native US Treasury, user of US Treasuries, and their vault is about half filled with treasuries, but we have a lot of incumbents in the TradFi world that are getting into treasuries. So Franklin Templeton is one. They've got a huge fund. Ondo is one. In the other types of RWAs, I know Onyx is a platform by JP Morgan that's Axelar, who is just up here. They're an interoperability solution for that. So we're getting this exploration already. Fidelity, Wisdom Tree, a lot of these incumbents are getting interested. Maybe they're interested, maybe they see the writing on the wall, and it is adapt or die because crypto is not going away. We are here. But otherwise, they're getting their feet wet, and US Treasuries seems to be a popular route for that. It is an intangible financial asset, which makes it a little bit easier. It's already digital. Those tangible assets, like a house or a Rolex or a commodity, you have a few more steps. It's a little bit more complicated to get them on. So I think that's why we're seeing these intangible financial assets, come on first or get a little bit more adoption first. Just another look at some, RWA early movers, people that are getting involved very early. And now I'm going to shift focus a little bit into DePIN. Has anyone heard this acronym before? Hand up. Okay, a couple people. We love our acronyms, which is why it's so hard to get into this space. We keep using terms like DePIN. That doesn't mean anything. It means decentralized physical infrastructure networks, which is a Messari term that was coined. And it is not real-world assets, but I find this to be real-world asset adjacent. And this is a very popular narrative, in the broader crypto space. It's kind of like looking at commodities. So, Bitcoin, the first crypto, is kind of like DePIN money. It's just a decentralized infrastructure network for money. And it's, adjacent to peer-to-peer. It's kind of like that. But another way to, look at crypto is, it's not money. Money was the first implementation. There are other implementations of what you can do with this. Maybe compute, like computation. That is something we generally all have. We all have a phone or a computer, and we all definitely use it. Bandwidth is another one. So there are these ideas. What other things can be built with this decentralized architecture? What other commodities can be best distributed that way? Other than just money. And we get all the nice properties we like about on-chain currencies and things like that. So these are, more so commodities than assets, but it is a parallel to the interest in RWAs in that people see the benefits of blockchain. People want to put, other products, things they use, tools on chain. And, DePIN is growing a lot. A lot of it is in Solana world. A lot of it's on Ethereum. But you'll have things like, if I'm hopping on a Zoom call and it has to go to a data center across the world and back for me to talk to someone in my city, we'd have a little bit less ping if I just used a local server because if we did a distributed network. And like computation too. If you've got a gaming computer sitting at home and you're not using it, well, you could rent out that GPU rather than a Google Cloud warehouse. So there are, reasons to kind of tokenize a lot more things, put a lot more things on chain. Now, onto RWAs and the XRP Ledger. I'll get into a bit more into Headwinds because, let's do a little bear posting. Let's talk about the other side of this and not just be totally bullish. Like, what could hold RWAs back? The demand side is one. So I talked about that regulation, right? You're not dealing with a completely, sovereign asset in that sense. So do users want that? We're seeing adoption start to pick up, and with currencies, with stablecoins, they seem very okay with it. But still to be seen with certain types of RWAs, private credit and things that have not seen the same level of adoption. So we have yet to see what the demand side looks like. We have yet to see if after institutions dip their toes in, do they really want to get involved with this? Part of that is, us in this room, we're trying to make it as easy to use as possible, but you might end up with the worst of both worlds if you have the crypto people saying, this is not fully sovereign, I want full sovereignty, and you have the institutions saying, hey, I used to have complete control over this asset, and now I'm giving some of that up to put it on chain. I don't know if I want to do that. So, we need to keep working to make these things attractive and easy to use, and, try to mitigate some of these possible friction points that we're going to have. But past headwinds, looking at where we are with the XRP Ledger, we have some existing infrastructure that works pretty well. We have native assets. It's pretty easy to deploy. We have functions like clawbacks. we have a central limit order book and an AMM built in. And David mentioned this in his talk yesterday, talking about the AMM has some strategies to fight impermanent loss, which I think is super cool, because if you are kind of plugged in a few different communities and you live in a couple different worlds, you notice these things really rhyme a lot. PBS, Proposer Builder Separation, is the exciting strategy on Ethereum to get rid of MEV, to get rid of that maximal extractable value, where block builders, with their privilege to create blocks of transactions, might be able to get a little extra money out of that. So auctioning off the right to build blocks is kind of what the AMM is doing, with auctioning off the right to be this arbitrage between pools. And again, tying into other talks, Wietze was talking about, hey, we're knocking down these walls, we're not building in silos anymore. There is so much overlap and so much rhyming between what's going on in these different ecosystems. So some of them, in the XRP Ledger community, we are maybe borrowing some learnings from other places, and then other communities are borrowing some learnings from the XRPL. I mean, Pathfinder's been around for the entire existence of the network, which really helps you source liquidity from other places. And pathfinding sounds just like Intents if you are building in the DEX world over on the EVM in most places, like the Squid router that was just talked about. It's, if you're a developer, the difference between imperative and declarative. And Pathfinder's existed for however long, and people are just now saying, wait a minute, we should build our DEXs that way. We should just put up one side, I want to make this trade, and let someone else come fill it with whatever path they want. So these learnings are being exchanged across different crypto ecosystems, and the lines are getting very blurry. I mentioned earlier how DeFi users and liquidity primarily live on the EVM. Well, yeah, a reason for the EVM being used on the Persist EVM sidechain, we have so much tooling. We can use oracles, we can use wallets, we can use all of this infrastructure that lives in other places and use it to our benefit in here. And that's where a lot of this comes together. So yeah, in the incoming infrastructure, we have that EVM sidechain, and we have DIDs, which is another big question mark on, okay, we want to be compliant. How are we going to be compliant? Yeah, decentralized identity, that way we're not totally fleecing everyone's privacy and airing out your details all over a public permanent ledger. And I think on a more macro scale, or a broader look at the ecosystem, is that XRP Ledger's community is growing, and I think it's growing at a faster rate than the asset XRP. And to kind of frame that for you more broadly, I like to think of cryptocurrency networks as two distinct assets. You have a network, which is this very secure and reliable database, and you have an asset, which people may like these things for different reasons. People may like this very secure database with this novel Sybil resistance mechanism, POA, on the XRPL. And they might say, cool, yeah, I love this. You can't just buy your way in. It's not like proof of stake or proof of work, where you can just buy miners or have more stake and then you get a say in putting transactions together. It's more like social consensus resources. And people might love that. But people might love XRP for a different reason. And that kind of gives you two different communities. And I think up until recently, we would see that XRP has a much larger community than the XRP Ledger. And I say that in terms of who is using XRP, who knows about XRP. Maybe they're using it off the network. They're using it on centralized exchanges because they want to invest in it or transfer it. And then you look at XRP Ledger, and it doesn't have programmability, so maybe people are not involved as much in the same way. I would argue Bitcoin is in a very similar boat. BTC has a larger community than Bitcoin, the network. We have the converse side of this, Ethereum and Cosmos. The EVM has extended way past the asset ETH. Cosmos SDK and their technology has expanded way past the Cosmos Hub, than what Atom has done. So we have these divergent relationships in those communities. We're now seeing a lot more growth in the XRP Ledger's community, the network. And that's because of this introduction of modularity and programmability. Things like hooks that are letting people build new things. The new amendments that we got in late 2022 for NFT transactions. You technically could have NFTs before that, but they are now first-class citizens on the network. And all of these little steps in technologies and programmability are getting us closer to more complicated narratives and allowing them to live on the network. Things like RWAs, that a lot of infrastructure is needed, and there's a lot of precursors to get these things actually live and living on the network. So a programmability renaissance is what you want, and it's bringing that in. And then we have Futureverse and Root Network. We have Sologenic and their Corium sidechain, and PeerSys and the EVM sidechain. Now we have all these other networks popping up where people have fully expressive environments. They have arbitrary programmability, and you can get a lot more creative with what you're building. So as Wietze said before, maybe we want to be on the blockchain that no one knows about. And that is true for users, right? Like, I'm a software developer by trade, and I have no idea how Twitter is built. Like the app on my phone, use it all the time, no clue. That's because it works. The only reason I would ever have to think about, is this built with React Native or Flutter, is if it wasn't working. If to tap your credit card, you had to know who's the clearinghouse and who's the, you wouldn't use it. If you ever have to think about those things, it means the product sucks. All we talk about is infrastructure here. We're very early, maybe still in the crawling stage, but his point was absolutely true for the people outside of this room, for the users. We don't want the users to know what's going on under the hood. They should just say, oh, cool, it works, and never think about it further than that. But for us in this room, we are explicitly aware of what's going on. We're all the nerds and the early movers in here, and we are the people that know what goes on under the hood with all these things. So for us, it's excellent that the community is growing in the developer sense, in the network sense, not just the asset, because both of these need to grow for its success. So that is a lot of what I am seeing in the XRP and XRP Ledger community, and this growth and expansion of programmability and this desire to bring in other sectors that build off each other, sectors like NFTs and DeFi and more expressiveness, more capabilities, more things to do with tokens like AMMs, more connectivity to other ecosystems, with solutions like Axelar and all that. And then that really lays the groundwork for the more complicated ones, for the ones with more moving pieces, our RWA narratives, our DePIN narratives, and the ones with larger total addressable markets. I mean, crypto itself, we're talking $1 to $2 trillion, but that is dwarfed by all of the other assets that get moved around and played with in the TradFi world. So the ceiling is much higher than where we are now, but a lot of definitive steps are moving in that direction. Thank you. That is all I have for my talk. I am Red from Messari, and I appreciate you all coming.